Silver is what I call a patience trade. It's very much like Bitcoin, and it's very much like uranium. And in that slide, I show recent charts of both Bitcoin and uranium, let's say going back about a year to a year and a half. And up until about a month or so ago, in the prior 6 months, both of those assets had doubled in price. And yet, if you looked at how they had behaved for a few years prior, they'd mostly gone sideways and then just exploded higher. And that's why I say silver is a patience trade, much like both Bitcoin and uranium tend to be. You get these long periods of very quiet, and then it absolutely explodes higher. For 1 ounce of silver to spend $40 versus $2,500 for gold, and I'm not saying that the gold isn't worth that. I'm just saying that for what you're getting for an ounce of a precious metal, the silver will make investors feel like they're getting a lot more for their money. And so fear of missing out is a very, very big driver in silver.
Will 2024 be the year for silver? Today with me is Peter Krauth. He's the author of a book called The Great Silver Bull, which is also available in my German language, called Großer Silberbulle. And I'm also a reader and a listener of the audiobook, and I really love the book. I think it's a great book. And Peter, you're also an editor of the website silverstockinvestor.com. First of all, thank you very much for your time. Thank you for being here.
Jan, thank you so much. It's a pleasure to be here, and I look forward to chatting with you.
Great. So as you already know, and as we can hear at my accent, I am from Germany. And to me, looking at our economy, at our decisions from our politicians, that all looks absolutely stupid, to me at least. You live at the other side of the world. What is your view on Germany?
So that's an interesting question. I do watch it, somewhat, and I'm sad to say that unfortunately Germany does not have a monopoly on bad politicians. It's unfortunately a pattern that repeats pretty much everywhere. Obviously, I see big mistakes. I see one of the biggest mistakes, or perhaps two of the very biggest mistakes I've seen being made is, Germany moving away completely from nuclear power. That's my opinion. And also relying so much on Russian gas. And we've seen in the last few years what the impact has been of that. So, even if relations are good with other countries, to have such a close and highly dependent arrangement is obviously does not make sense. We have to look for ways where we can diversify our sources of energy, our sources of supplies, and I think that the shock with Russia moving into Ukraine. The shock from COVID has made the entire world reevaluate how they can make their supply chains more robust. And, back to Germany for a moment, I think that the economy is clearly in a recession in this first quarter. And one of the things that really stands out is how farmer protests, have against things like subsidy cuts. I'm not one for subsidies, for example. I think, a free market makes more sense overall. But if competitors have them, then fair is fair. And if they're starting to cut their subsidies, forcing them to do things like keeping 4% of their land from non-arable, their arable land from non-productive uses, they're being forced to do things like rotate crops and reduce their fertilizer use. I just think that they have a lot of reasons to complain. They're not the only ones. But they're not being treated fairly. So all that to say, there's a lot of things that are being done wrong, unfortunately, and sadly, it's reflective of a lot of what we see that goes on in the West.
Unfortunately, and I think almost 100% of our viewers would totally agree with your opinion, and I do so as well. So, Peter, let's have a look to the US, which is at the other side of the world. As I said, at the Metals Investor Forum, I think it's just a few weeks ago, you said that 30% of the US debt will mature within 1 year. So we are talking about almost $9 trillion US dollars, and the Fed will probably have to step in because foreign countries are no longer very interested in buying US bonds, right? To me, it sounds a little bit like a trigger to a new inflation wave. What do you think about that?
So yes, Jan, I think you're absolutely right. The Fed will likely step in at some point. This trend was already in motion for some time, probably, I would say, especially since the great financial crisis, 2008, 2009. But I think the real trigger and really what made the rest of the world wake up was Russia's move into Ukraine, which caused the US to essentially weaponize the US dollar and freeze Russian assets. And so, the way I see it is you have these large investors, not exclusively, but large, especially sovereign investors, central banks, high net worth, large investment funds are looking at their exposure to the US dollar through treasuries, especially, and they're saying, we may be friendly with the US today, but who's to know what will happen tomorrow? And so they've looked at alternatives. I think gold has become that natural, obvious alternative. If you look at the charts in terms of what's happened with gold buying, it's clear that the buying from central banks in gold has been almost off the charts. I think it was something like 1,080 tons in 2022, almost 1,040 tons in 2023. And I did some quick math on this a few weeks ago, and I looked at what the implications were. So the overall, we won't even talk just mine supply, but overall supply of gold to the market every year is about 4,700 tons. And so if central banks alone are buying about 1,000 tons or over 1,000 tons per year, that means that they're buying almost a quarter of the entire supply of gold every year for the last 2 years. I can't see how, that's not going to have some impact. And if we ask ourselves, why are maybe some of the mining companies struggling? Well, the central banks and the large sovereign buyers are not interested in mining stocks. They're interested in the physical gold itself, nothing more. And it's because it has such liquidity, it has anonymity, it's accepted everywhere by everyone. And on a little interesting note on our side note on that is that I just read that the government pension fund in Japan is now, which is apparently the world's largest pension fund, period, is starting to look at, and this was what made me laugh, is they called illiquid assets, including things like, of course, real estate, land, illiquid, but then also in that same headline, they include gold and Bitcoin. And I'm thinking, who is your editor? Who's allowing that headline to say illiquid assets and put gold and Bitcoin in that headline? Just makes absolutely no sense. But the more important aspect of it is the fact that they are actually looking at these kinds of assets, and it's outside of their mandate. Mm-hmm. But nonetheless, they're asking for information, and they're looking for that research to start exploring these assets. So, if it's been out of their mandate, it has been for the longest time, and they're starting to look at this now, and they have so much buying power given the size of their funds. It really tells you, the attraction that is coming towards the precious metals. And I think that sovereign investors, like I say, they don't want to be stuck with treasuries. And I think that, this need for the U.S., because they have so much of their debt maturing in such a short time now, this, as I say, about a third of it in the next year, I think that will be a trigger for the next inflation wave. There's no way that foreign buyers are going to soak that up. It's going to have to come from internally. The Fed will have to embark on a new phase of quantitative easing. And perhaps it's going to come after the election if they want to, stay out of hopefully doing anything large that impacts anything in advance of that. But yeah, that's certainly what I'd be looking for.
Thank you very much for all those informations. It's funny that they are talking about illiquid assets and mentioning gold and Bitcoin as we have already laughed. So we've touched on gold, and I will be talking a lot about silver today. But before we go deeper into the precious metals, let's stay with the commodity sector itself for a second. you also said that this might be a trigger for a second inflation wave. We already had the first, and usually the higher inflation is a trigger for a commodity cycle, right? But this time there was not really a run on the first inflation cycle. So what do you think is going to happen? Will we see the second inflation cycle? Will that be the kickoff for resource stocks and for commodities itself? I mean, we've already seen a great hike in the uranium price. What will follow next?
So yes, I do think that we are going to see another large wave. I mean, one of the things that, and I do actually talk about this in the book, I have a chart from Crescat, which does some fantastic research. And so what they showed was that in the 1970s, there were three waves of inflation. One was the late 60s into early 70s, then mid 70s, you had a second wave, and then late 70s, you had the final and largest wave. And that's when in the US, you had interest rates going to, 15, 18%, and they had to raise rates. Volcker had the Fed chair at the time had to raise rates to 18 or 20% to break inflation. Now, it was a very different time because in that decade, the U.S. debt to GDP was only 35%. Today, it's over 120%. So to think that their economy and their budget could absorb, high rates on their outstanding debt of inflation, interest rates of anywhere close to those levels, it's absolutely impossible in my view. And so the only way is to keep rates low, to monetize the debt, have negative real rates ongoing for a considerable amount of time. And so in that sense, you end up inflating away the debt. If we switch back to commodities in that case, I think that the commodities bull that we're in now actually started in 2000, 2001. And I think that it's what I call a secular and a generational commodities bull. Mm-hmm. And I think that what happened from 2001 to 2010, 2012 or so, when we had that very strong decade-long run, was just the first half of that bull. And then we've had the correction since then, and everybody is waiting, of course, for the second phase to start. I think that the first part, at least, of this second half of the commodities, the secular commodities bull, is going to be one that's driven by supplies as opposed to demand. I think that we're like in the 70s, a stagflation environment. The economy looks okay, but it's really not all that healthy. And so rather than because there's such strong demand that outpaces supply, I think that demand will stay pretty much reasonably strong, but it's going to be lack of supplies that is going to cause the shortages that trigger and push us into a new renewed commodities bull. And I think it's going to be the second part of this second half. So maybe a few years from now, we'll kick into a demand-driven commodities bull. And I think that, it's going to be once monetary fiscal stimulus kick in, as I say, when they really need to, in a bigger way, monetize the debt, that we could get bigger demand driving this very much generational commodities bull market.
Right. So I think uranium has already showed that we're talking probably about a supply-driven bull cycle here, because I think uranium, there was an undersupply for quite a while. So I think that might be the case for other resources as well. Thank you very much for your thoughts. Let's switch to silver. I do have my gold bull here, but you're the great silver bull. So my gold bull has already climbed to an all-time high in probably all major currencies, but silver is still underperforming. Peter, do you have any idea why is that?
So you make a good point about all major currencies. And I was at a conference just recently in Zurich, and I was asked if I thought that gold was finally in, kicking off a new rally, a new bull. And one of the big indicators for me was that it should be hitting all-time highs in all major currencies. And finally, it has done that. The last holdout was not the US dollar, but actually the Swiss franc. And we've seen that in the last few weeks. It actually broke out to a new all-time high in Swiss francs. And so with that, as one indicator at least, I think that is a big strong suggestion that we are in a sustained a new bull market for gold. Why has silver underperformed? And that's a question I've been asking myself for quite some time, and obviously I've been getting that question from many. So a few months back, I decided to do some research and look for what I thought might explain, why, if we've been facing structural deficits in the silver market for about 4 years now, from 2020 until even last year, and we're expecting another structural deficit this year. So if we're facing deficits and demand is so strong for silver, so supply is not meeting demand, where is the silver coming from? And where and why is that price seemingly facing a ceiling of maybe say $26, $28 or so for the last 3 years? And so I had a feeling, or I had an impression that the large consumers were getting their silver somewhere, because you could have a deficit for a year or maybe two, and someone will try to adjust in terms of the requirements, but at some point they need to get the silver. And now we're in a market where about 60% of the annual demand is going just to industrial. And a large part of industrial is solar. And we know the growth of solar has been tremendous. Just in the last decade or so, solar panels have tripled their requirements of silver, just because so many solar panels are being manufactured. So again, these large consumers of silver are getting their silver somewhere. And if you look at, so the way the silver market works is that you have a certain amount going to industry, which is about, say, about 3/4 of the physical, and then about a quarter goes to investment demand. In a year when you have oversupply, in other words, if you combine mining and recycling, and that's your total supply, and demand overall is below the supply, then the surplus gets pushed into the futures markets, and it gets absorbed by ETFs. So they accumulate stockpiles, let's say, which I call secondary inventories or secondary supply. That's my term. And so this had been building up for probably about 7 or 8 years, up until about 2020, 2021. And if you look at the charts from the 3 major futures exchanges, there's the COMEX in New York, you have the LBMA in London, and then the Shanghai Futures Exchange in China, of course. Their overall silver inventories have fallen about 40 to even 50% in some cases in the last 3 to 4 years. So we had not seen this phenomenon until just the last few years. So you see a steady decline, gradual, every quarter, every year of silver supply or silver inventories in those markets. The same had been happening with the silver ETFs. And I've done some research with the SLV, which is the world's largest silver ETF. It's something like $10 billion of worth. It has about, I think it's over 440 or 450 million ounces of silver. And this ETF was started in 2006. And if you follow the silver price and you follow the silver holdings, because it's backed by silver, apparently, that's another story, but it's backed by silver. And so you look at the silver inventories in the SLV ETF, even when you had silver spikes and their silver holdings would move up, when you had corrections in the silver price, you would rarely have any kind of sustained correction in the amount of silver that they held. In other words, people were still overall buying that ETF. And it's only in the last 3 years that, despite the silver price being stable, the holdings in the SLV ETF has also been drained, very much like the futures exchanges. So if you look at the 3 large futures exchanges, the largest silver ETF and ETFs, silver ETFs globally, they've all seen their inventories fall. So My theory is that you have large consumers of silver who are buying long futures contracts. They're buying silver ETFs. On the futures contracts, when those contracts mature, they're going to the issuer and they're saying, I want my silver now. Now, the futures markets were not built for that. They were more built for hedging and speculating, but you can take delivery. And I believe that that's what's happening. Many of these large consumers are taking delivery on their futures contracts. They're also buying silver ETFs, and they're going to the issuer and saying, here we are. I have so many units of this ETF. I would like the silver in exchange. And if you own enough of any given ETF, you can actually receive the silver delivered to your location of choice. I believe that's really what's going on and why we've seen these inventories drain. And that has, because these large consumers have gotten the silver from secondary supplies, it hasn't had to come from producing more in the last few years. That has kept a bit of a cap on the silver price.
Okay, that's really interesting. Thank you very much. And let's pretend your idea, your theory is correct. I mean, to me, it sounds good because it makes absolutely sense. But do you have a feeling how large these stockpiles are? How long will it take until the silver market implodes under the circumstances?
Right. So actually, something that I forgot to mention was that these inventories, if we're speaking of the futures markets only, we ignore the ETFs for a moment, which is a smaller portion of overall secondary supplies. But at the futures markets, the inventories are down, say, 40%. But if you take delivery from a futures contract, you actually have to tap into what they call their registered silver. Mm-hmm. So that's a portion only of the inventories at a futures exchange. And the registered silver is actually down 70% over the last 3 years. So that's even a clearer sign that the silver has been drained by contract holders who are taking delivery. So it's hard to know. I've seen ranges of secondary inventories going anywhere from about maybe 2 billion ounces to as much as 5 billion ounces. It's all really speculation. There are no clear numbers of how much, say, secondary silver there is. And this is just the futures markets and the ETFs. I feel it's only fair to count what we call hoarding. I mean, it's perhaps a misnomer, but it's really people who've bought physical silver and are sitting on it, and for their own investment purposes. And at any point, they can and have at different times in the past decided that if they feel the price is high enough, or if there's pressure, they need liquidity, that they would sell that silver back into the market. And so that's a source of supply as well. Really, if I had to make a best guess in terms of how long I think these stockpiles will last, my best guess is somewhere around maybe 12 to 18 months. I think that at the rate, I don't see any slowing down in this draining of these inventories. So if I assume at the rate that I'm seeing, I really think that a year to a year and a half from now is realistic when we will reach a point where someone is going to stand for delivery and be told, sorry, the silver's not there. We'll pay your contract out in cash, but that's not what they're going to want, especially if they're an actual consumer of silver, an industrial consumer. They will need the silver and they will scream and we will hear them scream. So that will trigger the market.
Right. So because there is a usage for silver, it's not just looking good, but you also need it, and the industry will need to supply, right?
Exactly.
So 1 or 1.5 years, in theory, that gives us enough time to buy more silver and to hold it, hodl, like the Bitcoin people would say. We don't do investment advice, but you said that silver might go up to $300. You did that call in, I think, 2023. We haven't seen the 50 US dollar mark for many years, to be fair. And whenever I bring up Keith Neumeyer's thesis here on the show that the silver price might go triple digits, some people freak out, right? Because we haven't seen it in a while. So how can you come up with the thesis telling us silver might be worth $300? And can you explain to me what your argument is for a triple digit silver price? That sounds really interesting to me.
Absolutely. So, I mean, I know, first of all, I'm the first one to say that, if you look at something like $300 silver, it looks sensational. My goal is not to be sensational. It's basically to look at what I think an ultimate target, an ultimate high could be. And I'm talking about in some kind of a mania phase for the silver market, where you would have just absolute, people are losing their minds. They have to have silver. You've got this fear of missing out, this FOMO happening. And so people can't get enough silver and can't get it fast enough. So, we've been in those kinds of environments before. That's partly what drove it to $50 back in 1980, and partly again to say 49 or almost $50 in 2011. But when I looked at what I thought could be an ultimate high in the silver price, I did it in what I feel is a rational way. I looked at history, and I looked at different indicators and different metrics. And I applied them to silver now. And I said to myself, okay, well, what target does that suggest? And so one of the widely followed and most easily understood is the gold-silver ratio. And the gold-silver ratio is very simply, for your viewers, the number of silver ounces it takes to buy 1 gold ounce at any given point in time. Right now, it's about 90. So it takes you 90 ounces of silver for the equivalent of buying 1 ounce of gold. And that's high historically. But if you look at what happened in the last true silver bull, let's say, I'm going to say secular silver bull, which was in the 1970s, the gold-silver ratio bottomed around 14 or 15. And so I, used what I feel were you have to make assumptions. This is the only way you can work with these numbers and apply the indicators. So I made an assumption for myself that ultimately in this secular bull market, that gold would reach, say, $5,000. Now, we're close to, 40% of that target. And people are already talking about maybe $2,500 this year, talking about maybe $3,000 perhaps even next year. So I don't feel $5,000 gold seems all that unattainable anymore. But if you apply the gold-silver ratio with gold at $5,000 and you apply just 15 to 1, you're at $333 silver. So, so that to me is close enough to $300. Then what I did, so that's one way that I got to somewhere close to $300 for silver. And as I say, we've seen that if you use, some people think gold will go to $10,000. If you use $10,000 gold and you use a higher gold to silver ratio, let's say 30. So that's easier to attain. It's not as low. But with $10,000 gold, you're still at $333 silver. So that's the gold-silver ratio indicator. Then there's inflation, and what I call, say, true inflation rather than, the headline inflation, which is, say 3% or so lately. So I'm being, I think, very reasonable, and I'm saying true inflation is closer to about 7 to 8%. So if you go back to 1980 and you adjust the silver price from its peak in 1980 at $50, and you project even just to today with 7 or 8%, then you get a range of, say, at 7, $240, and at 8%, $360 silver. So I go in between and I say $300 again within that range. Again, seems fair. And there are a few other indicators, but I'll explain sort of one last one, and that is the home price indicator. And so this is home prices in the US. And in 1980, if you looked at the average home price, and you convert it to silver, when silver peaked in 1980, it took 1,500 ounces of silver at $50 to buy the average US home. If you look at today, the average home in the US is about $500,000. And if you divide by 1,500 ounces of silver, which is what it took in 1980 when silver peaked, you would be at, again, $333. So I bring that price down again. Average, when you're forecasting, round numbers are fine. There's no point in being very specific. It would be silly. So I say $300. So those are three ways that I get to $300 silver. And in I guess, setups or environments that we've been through in the past. So I don't think Keith Neumeyer's $100 silver is unrealistic. My forecast is that, again, in a mania phase, ultimately it could easily run well above that. I don't think it would stay there. It would wreak havoc on industry, of course, which consumes lots of silver. They would be looking to substitute. It would price their products out of the market. And again, I don't think it would necessarily be sustainable, but is it attainable? That I do think it is.
Wow, all right. Thank you very much. That's pretty interesting. What's also interesting is that you came up with the 70s, right? And when I talked to Rick Rule just a couple of days ago, he was also referring to the crazy 70s in terms of gold stocks, silver stocks, everything really going up and breaking out. I mean, obviously, when silver rises, silver stocks should also be in the spotlight. But do you think we are in a similar situation than we've seen in the 70s, for example? Could that be the major bull run for mining stocks in general? Could it be that these kind of stocks are going to outperform everything else? What is your feeling on the sentiment overall?
Absolutely. I mean, I am, as you can imagine, very bullish, but bullish because of what I've seen and understanding the current situation and the current setup. Not just silver, but gold and other junior explorers, in particular, for other metals, copper, for example, and others. Copper has overall held up a little bit better, but gold and silver juniors have been very dramatically sold off. They're just incredibly cheap. And it's interesting that you mentioned Rick, because in a recent presentation that I did, I said, silver is what I call a patience trade. It's very much like Bitcoin, and it's very much like uranium. And in that slide, I show recent charts of both Bitcoin and uranium, let's say going back about a year to a year and a half. And up until let's say about a month or so ago, in the prior 6 months, both of those assets had doubled in price. And yet, if you looked at how they had behaved for a few years prior, they'd mostly gone sideways and then just exploded higher. And that's why I say silver is a patience trade, much like both Bitcoin and uranium tend to be. You get these long periods of very quiet, and then it absolutely explodes higher. And I had a quote under those two charts from Rick, which said, the silver equities are incredibly cheap, to the point where the value is so strong that he considers them stupidly cheap, that the market really is not in tune with the value that there is there. And silver, even more than gold, is such a small market. I know, because I research the stocks in the sector, try to look for the best quality stocks. And it's a narrow pool. It's a very small pool of companies that really have the best quality, either exploration projects or mines in production or in development, and so on. So they're extremely undervalued. What investors should look for, I mean, these are the kinds of things I think people know, but they need to still exercise the effort to do the research. You want the right people with experience in very much related either prior projects or companies. You want projects that have high grade and or scale potential, so the potential to grow considerably or already be large. You want preferably jurisdictions that are conducive to allow for mining, that are mining friendly, and then this is more difficult these days, but you would ideally want companies that are in a favorable cash position, that are not forced to go back to the market and end up, of course, naturally diluting shareholders. So these are the kinds of things that you want to look for. As I say, it's a small pool, but the best of the best will absolutely perform exceedingly well, I think, in the upcoming bull.
Great. Thank you very much for your information. And I think also a quote from Rick is, just because it goes sideways, it doesn't mean that you don't have to own it, right? I mean, especially that shows you that you have to own it.
Exactly. That is, I think, I like to say that silver's quiet periods and its volatility are, in fact, its appeal. So if people have patience, then and they're willing to buy, and in a case like say right now, buy in. You don't have to, it doesn't have to be an all or nothing kind of commitment. You can say, I like this company. I've done my research. It looks cheap. I'm going to buy a quarter, or I'm going to buy a third of the position I want ultimately to own, and watch it. There's nothing that gets someone more cautious and more involved with a given company than to just buy a few shares of it, because you've made that initial commitment. And so you will follow it closely, and then you'll determine, I guess, at that point when you feel comfortable making an additional allocation and to build up your position to the final, let's say, dollar or currency amount that you plan to commit to it.
Great. All right. Thank you very much for your information, for your statements on silver, and also talking about the silver stocks. But now I have one more final question. I mean, let's have a look at the age of our industry, right? If we go to PDAC, for example, most of the people there, except you and maybe some others, most of them could basically be my grandparents. And I don't really have the feeling from a young people perspective that our industry is doing much to attract younger people. So what do you think? What has our industry to do to attract more younger people? And do you think we need the younger people as well?
So, I mean, there are some things that are within, say, the industry's control, and others are not. I'm going to say one of the things that is not that is outside of the industry's control is higher prices. Mm-hmm. And clearly, and I know it sounds perhaps obvious and maybe even silly, but higher prices will cause excitement, and they'll cause a build of fear of missing out, and people will become more interested. And in fact, that's something specifically that I do talk about in the book. And gold is already the kind of asset that is the ultimate bubble asset in a way. People actually want to buy it more as the price goes up. Not that different, perhaps, from other stocks, NVIDIA, for example, or Apple, or any of these. But it is true for gold as well, and silver even more so. And what will happen, I think, is that people become interested in gold. You start, as the price goes up, new time. That's actually an interesting point right now, is that, think about this. Gold is at all-time highs in virtually all major currencies. And how many people are talking about it? That is a sure sign of an excellent time to get involved, because there's nobody buying it. You have a perfect setup. I mean, yes, perhaps you are paying more because it's at all-time highs, but the excitement is nowhere to be found. And when it comes in gold, and gold, let's say, makes it to, I don't know what it will take for people to start paying attention, maybe $2,500 US or something of that sort. But when you get the excitement start to really kick in, people will look at gold and say, oh my God, I need to get some gold, but it's $2,500 at this point. What else can I do? What else is there? And silver becomes the natural alternative to that, because even if silver is, let's say, $30 or $35 or $40 at that point, for 1 ounce of silver to spend $40 versus $2,500 for gold, and I'm not saying that, the gold isn't worth that. I'm just saying that, for what you're getting for an ounce of a precious metal, the silver, will make investors feel like they're getting a lot more for their money. And so fear of missing out is a very, very big driver in silver. But you're right. There is a lot for the industry to do. I think that the mining CEOs themselves there's certainly a range of ages, but they do tend to be a little bit older as well, for the most part. And so I think that many of them, not all, but many, are not sensitive enough to the idea of social media, wanting to use it, understanding how to use it. And we were talking about this just earlier, but Rick Rule has told me a few times that Sprott spent big money to research a few years back how to because they naturally want to grow their market and get younger investors interested and involved, and how to get them interested and involved. And after spending a lot of money to do the research, with perhaps not such clear answers, someone just came to them and said, Rick, you guys just need to get on social media. That's where all the young investors are. They're spending their time on YouTube, on TikTok, on Instagram, on perhaps less so on LinkedIn, but more so these days. I've noticed, at least, even young professionals, they're going to these social media sources, and they're getting their information there. Some of it's good. Some of it is perhaps not so good. A lot of it is narratives, but at least it's an introduction. And hopefully they take that exposure and then they take the time to start doing research. That's what one of my big focuses is that I try to always bring an educational angle to what I do. And so I think that, people, first of all, I feel like I'm bringing and adding value to something. And so if I can bring more understanding, better explanation, give people a better handle on a sector, on a given company, I feel like I'm helping them in that case. And so I think in any case, people need to spend time doing some research, even if it's basic research, and ultimately, as I say, start to get involved. You can make small commitments to a silver stock, for example, without taking large risks. And I like to give a couple of examples, and that is, I give these in the book as well, but two of the largest silver mining companies, or silver companies, one of them is not a miner, but one of the largest miners is Pan American Silver. And so between, I believe it's 2008 and 2001 and 2008, Pan American Silver, one of the largest public silver mining companies, was up 16 times. So that was a tremendous run for a relatively lower risk stock. Then you have a company called Wheaton Precious Metals, and they don't even mine silver. They're a royalty company. They have about 45% of their revenues come from silver. So that's really good silver exposure. And actually, you don't find that in other royalty companies. So if you look at the period of 2008 to 2011, Wheaton, which is a multi-billion dollar market cap company, not even mining silver, so lower risk, was actually up 17 times in 3 years. So you don't have to take huge risks in the silver space to have potentially very, very strong returns in obviously what ends up being a very supportive bull market for the precious metal. So hopefully that's helpful to your viewers as well.
Absolutely. Thank you very much, Peter, for all this insight. It was a great interview, and I've been learning a lot. And also, people can not just watch the video, they can also go ahead and buy your book, as I already said, also available in the German language. The German and the English version, all of this will be linked in the comments down below. Peter, thank you very much for your time. It was a pleasure to talking to you, and I'm really looking forward to have you here again pretty soon.
Jan, it's been my pleasure. I certainly look forward to coming back and talking all things silver with you again.
Perfect. Thank you very much, and have a great day.